So good evening. Welcome to our webinar looking at expense claims for hospital doctors and considerations around private practice. So we're going to cover off various elements around what can and can't be claimed, cover off some basics around income tax, and then as I said, look at the considerations around private practice using limited companies for that. As we go through, if you have any questions, please do pop them into the question box. We will pause at intervals throughout the webinar to address anything, and also some time at the end. Please do give some feedback at the end. I will do another reminder. Once the webinar finishes, there will be an automatic box that pops up to give you your feedback. And in particular, useful to know any particular topics that you would like us to cover off in the future is really useful for us. So just to introduce myself. So my name's Louise. I'm a partner at Larkin Gowan in the medical team, and I'm joined this evening by Jamie, who is a manager within the medical team, both operating out of Colchester. So let's dive right into things. So looking at tax claims for hospital doctors, we just thought be good practice, a bit of housekeeping, just to kind of go back over the basics of income tax, how it's calculated, and impacts of increasing income, and what that might have and what that might do to your tax position. So what is subject to income tax? Unfortunately, most things are subject to income tax. So the big one that we'll all come across in our lifetime is earned income. So this will be earnings either as employment. So if you are obviously employed within a hospital, your salary obviously subject to tax. And then if you do have private practice on the side, then that self-employment income would also be subject to income tax. If you are in receipt of a pension, so whether it be an NHS pension, a private pension, your state pension, again, all subject to tax. I think quite often there's a misconception that state pension is tax-free. It's not. There is no tax deducted from it like there would be from an NHS pension or a private pension, but it's still very much a tax deductible income, or taxable income, sorry. Interest on savings. So these don't include ISAs. So if you have current accounts, high interest savings accounts, bonds, etc., any interest on those are taxable. Now there are allowances, which we'll come on to a moment. So not all of it may be taxable depending on the level of your earnings. Investment income. So this could be any dividends you receive on shares that you have purchased or inherited. It could be if you have a property that you rent out, we treat that as investment income. Again, all subject to tax. If you are a beneficiary of a trust and are receiving a yearly income, that will be subject to tax, as are state benefits, job seekers allowance, widows pension, state pension we've already covered off. And then foreign income, which does get quite complex, but generally if you are a UK resident for tax purposes, you will pay income on your worldwide income, regardless of whether it comes into the UK or not. So you might have an overseas bank account, you might have an overseas property where rental income goes into an overseas bank account. Even if that income doesn't come into the UK, you are still liable to tax on your worldwide income. If you are paying tax in that country also, then there could potentially be some credit for foreign tax already paid, depending on any treaties that the UK has with that company, with that country, sorry. What is not subject to income tax? So as I've covered already, ISAs, so if you have stocks and shares ISAs or cash ISAs, they are any income, any interest or dividends earned are not subject to income tax. If you rent a room in your house whilst you are still living there, you can earn up to £7,500 a year tax-free. You do have a choice as to whether you can do the rent a room or you would just do normal looking at income and deducting expenses. But generally, if you are renting a room, you can earn income up to £7,500 per year. Premium bonds and just generally gambling winnings are not taxable, so we all just have to hope we win the lottery. And then, yes, some tax credits, so housing benefits, working tax credits, child tax credits. Child benefits, now they're not taxable to a degree, but if you as a household earn over £60,000, then you would, and are in receipt of child benefits, then you potentially might have to start paying some of those child benefits back. And the rules have changed recently on this and how they calculate the income threshold, because it used to be on an individual earning more than 50,000. It's now a household earning more than 60,000. So whether you're employed or self-employed, you will pay income tax at the same rate, whether it be employment earnings or profits that you're making. Now, at the moment, we're in a period of frozen tax rates. There was a very slight change in 2023-24 with the higher rate cut off before it hits to the additional rate. That was brought down. But certainly for the current tax year that we've just finished, 23-24 through to 24-25, the rates are frozen. So everyone potentially has a personal allowance up to £12,570, at which you can earn tax-free. After that, up to £50,270, so about £37,500, you pay tax at 20%. The next kind of 75,000 is at 40%, and then anything over 125,140 is taxable at 45%. Now these are tiers. It's not an all or nothing, so it's a stepped up approach. So the first 12.5 is tax free. The next 37,700, 20%. The next 75. 40%. So if you breach into the next tax bracket, it's not all of your income that's taxable, it's just anything in excess of that bottom threshold. So personal allowances. So this is the £12,570 that is tax free. They are individual and they are specific to each person. Usually they can't be transferred. There are some rules around marriage allowance, but it's a very small pool of people that can attract that. And it can't be carried over. So if you don't earn any income in 1 year, you lose effectively your 12,570. Now, where we have to be careful is once your taxable income hits £100,000, you start to lose some of your personal allowance. And for every £2 you are over, you would lose £1 of your personal allowance. And that's why they've slightly tweaked that additional rate threshold at 125,140, because it's at that point of taxable income that you would have completely used or completely lost your personal allowance. And so it does work out that there's a slightly higher marginal rate of tax in that period where your personal allowance is being phased out. And so where we talk about later on having options if you undertake private practice. This could be one of the reasons why, and we've got a slide just in a moment that talks about the impact of losing your personal allowance. Now, I said a moment ago that with bank interest, there is an element that you may not pay tax on, depending what type of taxpayer you are. So, as a basic rate taxpayer, there's £1,000 as a personal savings allowance. So you can earn £1,000 of interest before you start to pay tax on it, anything over that £1,000. If you're a higher rate taxpayer, so you've moved into the 40% tax bracket, that halves down to £500. And if you moved into the additional rate taxpayer, you have no personal savings allowance. So you will have completely lost your personal allowance and you will have lost your savings allowance also. Now, just to complicate things slightly more, there is what we call a starting rate allowance of £5,000. So if you are a lower income for whatever reason for any particular year, or if you have a spouse that's a lower income, doesn't earn more than 17,000, then actually you get £5,000 as a starting allowance for savings. So it can be sometimes useful to think about if you've got higher interest bearing accounts, whose name are they in, if you've got a lower earning spouse. Now, the 20%, the 40% and the 45% tax thresholds will apply to earned income and income such as rental properties or rental profits. If you have dividend income, they have their own tax bands or tax rates, I should say. The bandings are the same. It all falls into the same bandings, but the actual tax rates that are applied are slightly different. With dividends, again, there is a separate allowance. So you can earn £1,000 up to April or 5th of April 2024 before you pay tax. That's now reduced to £500 from the 6th of April of this year onwards. So it doesn't matter if you're a basic rate, a higher rate, an additional rate taxpayer, you still get the same dividend allowance, so £1,000 or £500, depending which year we're looking at. What's different then is the tax rate. So if you are a basic rate taxpayer, so 20% on earned income, 8.75% on dividend income, 40% taxpayer, so you're a higher rate taxpayer, they're 33.75%. And if you're an additional rate taxpayer, you're paying 39.35%. So slightly lower rates of tax. And obviously, there's no national insurance charges on dividend income. So again, it's something else to think about when we come to talk about private practice towards the end of the session. So let's just put some numbers to it, because we're accountants, we like numbers. Just to kind of show you the impact of personal allowance and what it does to your tax liabilities. Very broad brush here. So to make life nice and simple, we are right on the cusp of that 100,000. So this is a salary, £100,000. So this would be net of pension contributions. So when we talk about losing your personal allowance and that £100,000 threshold, we look at your taxable income. So with your employment, you will, if you're in the scheme, have your pension contributions being deducted on your payslip. So we have to look at the taxable pay after the deduction of your employees' contributions. Because we're on the cusp of the 100,000, we retain our full personal allowance. So income subject to tax is £87,430, and the liability on that calculates at £27,432. Now, if we do the same example, but someone perhaps has some private practice in there, about £20,000 of additional income, because we have now breached the £100,000 threshold, we're 20,000 in excess of that. So we would lose £10,000 of our personal allowance. Every £2 we're over, we lose £1. So we only now have an allowance of 2,570. So once we work through the tax figures, the liability comes out at 38,952. So for an extra £20,000 of income, it generates an extra £12,000 of tax, which is a 60% tax bracket. And ultimately, it's because we're obviously paying tax at 40% on the extra £20,000, but because we're pushing more income from 20 into 40, because we're losing the personal allowance, that's how we end up with this marginal rate of 60%. So that's why it's quite important that to try and, where you can, do some tax planning to keep your taxable income either under 100,000, because we also have considerations such as tax-free childcare that can be lost once you exceed that threshold, or you almost want to go way above it, that actually it doesn't really make any difference. So that was just a very kind of quick back to basics reminder: what's subject to tax, what's not subject to tax, how we consider the personal allowance in all of this. So I'm now going to hand over to Jamie, because I don't think we've had any questions that have come in on that section. But as I said, if you've got anything, just a reminder to put your questions in the into the chat box. And Jamie's now just going to kind of touch through and talk about some expenses and how we can maybe bring some of this tax liabilities down.
Thank you, Louise. Wait for the next slide to load. So the expenses that you can claim against employment income are quite strict compared to if you were self-employed, a partner, whatnot. So I said we'll go through some of the expenses you can claim, just so that you've got examples, and if they can apply to you, then obviously you can put these against your tax return. Or if you are solely employed, if your expenses don't exceed £2,500 and you don't do a tax return, you can just claim these on a P87. If they do exceed £2,500 and you're not doing a tax return, you do have to claim on a tax return, unfortunately, so you would have to register for self-assessment. So some of the claims that you can claim, the expenses you can claim against your employment, need to be wholly, exclusively and necessary for you to undertake your duties as an employee. Now, it's that necessary that's important, and that's what's different between employment and self-employment. You lose the necessary when you're looking at self-employment. So for it to be necessary, it needs to be allowing you to do your job. It's necessary for you to do your job. However, a lot of people will think, okay, I need to do my CPD, that's necessary for me to do my job. However, it isn't. CPD is preparing you to undertake your duties of employment, not actually allowing you to do them and perform your duties. So there's a slight difference, and that's how HMRC sees it, and therefore you can't claim any CPD costs yourself. There is an exception to this rule if you were on a training contract. So if you are in the training phase of your career, and it's sort of in your contract that you have to undertake your training, and that you have to pay for them yourselves, and if you don't undertake these, that you will actually lose your employment, then you can claim them. So it does have to be in your contract. And you have to be on a training contract to do that. There is a list with HMRC of courses and exam costs that are allowable. It's not exhaustive, but most of the common ones are on there, so you can double check if you're not sure on that as well. And then other ones that can be claimed are sort of your professional subscriptions. I've just skipped down to the bottom of that one. Professional subscriptions. So there is an approved list by HMRC, which is called List 3, which lists lots of professional bodies where you can claim your subscription. So MPS, MDU, BMA, GMC, they're all on there. There are some other ones on there. A lot of foreign ones aren't on there. So you do have to be careful with those. I say the list isn't great to search by. It's not sort of in alphabetical order or anything like that, by first word. So like if it's got council in, it won't, say if it starts with council, it won't be under C. So you just have to go through the list quite extensively to check if they're on there. But all the common ones are on there. Other expenses you can claim are for uniform. So if you are having to wear specialist clothing, so like a uniform, tunic, or something like that, you can claim for the cost of replacing the uniform or cleaning the uniform. If you have to, like tools or equipment that you have to buy to do your job, again, repairing or replacing those can be claimed as well. Unfortunately, you can't claim PPE. If your employer requires you to wear PPE, they should be providing it for you. If it's a case that you're just wearing it because that's what you prefer, unfortunately, that's not an allowable expense to claim. You can claim from working from home, but however, the rules were a bit relaxed during COVID. They have tightened up again now. So you can only claim from working from home if your employer requires you to work from home. And that's normally because you live far away from the office, or your employer doesn't have an office. If it's your choice to work from home, like you voluntarily work from home, or there's some flexibility again from your employer, but they don't actually require you to work from home, then you can't claim this. If it is mandatory that you work from home by your employer, you can claim £6 per week for that. There is an option to claim additional expenses in regards to that. The £6 is just a flat rate. However, it can be quite difficult to prove what extra costs are associated with working from home, but it is doable if you want to go through that. You can also claim for travel and overnight expenses if you have to travel for work. Now, this is different to travelling to work. So if you have to go see patients at home or anything like that, you can claim those. Travel to courses you're allowed to claim for as well. However, if you choose to stay at a hotel because it makes your normal commute more convenient, then those can't be claimed. So a lot of people do work quite far away from their home, normally because they've been picked to go to that certain hospital. Unfortunately, you can't claim for staying at a hotel near the hospital or the surgery the night before, or if you've got off a late shift, you stay there and then you go home and whatnot. So unfortunately, HMRC's view is that you choose to live where you do and work where you do, and therefore the cost from travel from home to work isn't allowable. Other ones, so this is against self-employed. So you can see this is slightly different and a bit more relaxed if you're self-employed versus employed. So again, you can claim your subscriptions. So again, all the normal ones, NDU, MPS, GMC. But again, if you are a partner, perhaps, make sure that they haven't already claimed them in the surgery for you. So if they've paid it for you, you can't obviously claim it as well on your tax return separately. Or if you are self-employed at a surgery, again, if they pay it for you on your behalf for whatever reason, if you are self-employed, it's very unlikely. But again, it's just making sure that if they are claiming it, you are not claiming it. You can claim for telephone and internet. So if you are having to use your mobile phone to call patients or make calls, for even if it's CPD training or something like that, then you can claim a percentage. It's a business use percentage of your cost for the phone and the internet on those ones. Now, the telephone is different. So you can claim it if you're self-employed. You can't claim normally telephone if you are employed to make those calls. Now, the reason being, I say you can't claim it. There are instances where you can claim it. In fact, if you can substantiate the actual individual calls and the cost of those calls. Now, a lot of people nowadays don't have pay-as-you-go phones. They're on contract. So you'd actually probably normally incur that contract cost anyway. And you're using it for personal and work. So again, you can't claim it against employment, but you can claim it against self-employment. The courses, travel and subsistence. Again, we've covered that a lot on the slide before. So courses you can claim if you're self-employed, if they're CPD or not, and gaining more knowledge, not necessarily new knowledge. If it's gaining more knowledge, then you can claim for that. So under employment, you couldn't. And travel to those courses is allowable, and subsistence. So if you are away, some courses will run for a good couple of days. If you are having to stay for those courses and you obviously have to buy for food and stuff, you can allow an amount for subsistence as well. Oh, I would be careful of, and this was a question that was asked previously, some courses are abroad. So you just have to be careful, because you can claim the cost of the course abroad, you can claim the cost of travel. Now, however, if it's a case that your course is 3 days and you've actually booked 5 days to be away, HMRC would look at it and say, oh no, that's a duality of purpose. You're going there for play tourist or whatever, have a nice relaxing holiday for a couple of days after your course. You do have to apportion then your hotel, your flights, and any other costs associated with staying abroad for that course. You just have to be careful with those expenses. You can pay a spouse a wage if you are self-employed as well. It does have to be commensurate with the duties that they undertake. So if they do some admin work for you, you sort of have to pay them what you'd pay a third party, unrelated third party, to do that work for you, and you can claim that as an expense and get tax relief on it. You do have to be careful though, because depending on the amount you pay them, it could mean that you yourself have to run a payroll, or it could mean that your spouse is then self-employed themselves and have to do a tax return as well. So you just have to be careful on those. And again, you can pay the spouse a pension into their pension as well. Computer equipment and consumables, again, this is subject to business use. So if you've got a laptop you use for work purposes and you've bought a new laptop, again, you say it's 50% for business use, you can claim 50% of that cost against your self-employment income. And locum insurance, again, you can claim, assuming again it's not claimed in a practice account, if you're a partner. You do have to be careful with some insurance. It does have to be a proper locum insurance expense. There are ones which are like life insurance or sickness insurance. It's not a case that it's just a general payout. It's to cover locums. You can, again, this is for self-employment income, so you can claim use of home. So whereas before I'd mentioned the use of home, working from home, the £6 per week claim, it's slightly different with self-employment. So it's based on the average number of hours you work from home each month. So if you sort of do 25 to 50 hours per month, you can claim £10 per month against your income. And again, it's 51 to 100 is 18 a month, and 101 hours or more is £26. So it does go up. And it's nice and easy. It's just a flat rate to claim. Now, this is on top of sort of your telephone or internet expenses, so you can claim both, because what essentially the use of home is doing is claiming your utilities like your light and heat, gas, those type of expenses. And then on top of that, you can also claim a business proportion of your mortgage interest rates, big repairs to your house, or anything related to sort of if you've got an office, I don't know, like a desk and stuff like that, you can claim those. Now, when I say business use, you do have to be careful because it's based on the use of your use of home. So the hours that you've worked at home over the course of the year. So if you've only worked 25 to 50 hours per month, that creates a sort of, if we go top end, 600 hours per month, 600 hours over the course of the year, but over the year actually there's 8,760 hours. So when you actually take it as a proportion, it only works out to be sort of 6.85%. And then because you're not using the whole of your house to work from home, you're sort of probably only using one room, maybe the office and maybe the bathroom, maybe the kitchen for a little bit to make a cup of tea or a sandwich or whatever. So you can only then have sort of take one room out of how many rooms you've got in the house, so 1/7 or something like that. So it does reduce the percentage you can claim down quite a lot. So a lot of people don't bother with this, but it is something that you can claim if you want to. Again, we're still on self-employment. So motoring costs. So normally what's nice and easy is 45p per business mile. So employees can claim this as well, 45p per business mile. If you're having to go see patients at home and stuff like that, you can claim 45p. Normally, sometimes your employer will reimburse you the 45p. If they don't, you can claim it on your tax return or submit a P87 claim to HMRC. So it's 45p for the first 10,000 miles and then 25p thereafter per year. So it does renew every year. And it's for the business miles of your car. Now, what's classed as business mileage is like home visits to patients, travel to courses, but it will depend on where your base of operations is. If you are self-employed and you are working at multiple surgeries and sort of you're not there long term, it's sort of maybe you're doing it for an agency type thing, and sort of you're at a different surgery each week, your base of operations is likely your home, and therefore you can claim business mileage from home to the surgery. If it's a case that you are working at a surgery for a self-employed, sort of a self-employed locum for a long period of time, so we're there for a good few months, you're the same sessions every week, your base of operations is going to be the surgery, and therefore travel from home to the surgery isn't allowable. So you just have to be careful on that distinction. So that's the 45p per mile. The other method you can claim is a business portion of your total running costs of the car plus capital allowances. So basically you add up all of your fuel, your road tax, your insurance, all of those types of costs that say for the running of your car, and then you claim the business proportion to those costs. Again, the same rules apply. Say the business use of the car doesn't include commuting, so you just have to be careful on those ones. And what we also do is we capitalise the value of your car. So what you bought your car for, we capitalise it, and you claim capital allowances on that every year. It's based on the CO2 emissions of your car, either 18% or 6%, depending on how high they are. And it's just sort of there's an allowance for depreciation of your car. So for the wear and tear of your car, it's another relief you can claim. You do have to be careful though if you've got your car on finance and how you finance your car. If you bought it outright, happy days, you can claim capital allowances. If you have got a finance on a PCP, which has got a big balancing payment at the end, it might be the case that it's classed as you not owning the car and you're actually renting the car, and therefore we can't capitalise the car. It's actually treated as a rental, but you can claim for the rental expenses of the car. So what you're paying for your PCP, you can get relief for. And likewise, if you have got a true hire purchase on the car or a separate bank loan, again, the interest element of those can be claimable subject to the business use of the car. With electric cars, a lot of these obviously coming a bit more common nowadays, of electric cars, you can claim 100% first year allowances on electric cars. So this is basically, so if you bought a car for £40,000, electric car for £40,000, in the first year you can claim capital allowances of £40,000. So that just reduces your profit. Now it is subject to business use, so if you've only got a 50% business use, basically you can claim £20,000 against your self-employment income, so reduce your profits down, and then that's what you pay tax on. So it is reducing your profits for tax. People like it because it's, say, if you've got a year maybe when your income has gone up quite a lot, it's a good thing for tax relief. Now it is more of a cash flow incentive or reward. I don't know if it's a reward, but yeah, it's more for cash flow purposes, because over the life of the car, if you then sell an electric car, then you basically have to pay tax on what you sell the car for. And it's the same with the normal capital allowances. It's just, say, with normal capital allowances you get a little bit each year. With first year allowances you get sort of all of it in the first year, and then you sort of have to maybe pay a top up at the end when you sell it. For it to be an electric car, is it fully electric or 0 grams per kilometre CO2 emissions to get the first year allowances? And I say the car has to be purchased outright or with a bank loan. If it's under like a PCP, which has got those big balloon payments at the end, it could be classed as a rental and therefore you can't have it.
Jamie, just before we move on, there's just a couple of questions that have come in, which you might just want to, before we sort of move away from allowable expenses. So from what you're saying, apart from professional subscriptions and business mileage, there really isn't very much that employees can claim through PAYE. Is that right?
So it is a lot more restricted than self-employment. There isn't much. I say there's the business mileage, the professional subscriptions. If you are on a training contract, your training costs. I say if you do have to buy your uniform and stuff like that, there is that expense of replacing it and cleaning it, and the tools that you use or equipment that you use to do that. Apart from those things, they're the most common ones. There could be a few more, but I say it's very restrictive. And they aren't as common as those ones. I say normally for employees, I say it's the 45p per business mile, or the professional subscriptions. There isn't that much, unless, Louise, you can think of a couple more.
No, I think it is pretty restrictive, and it's that wholly exclusive and necessary for the business. I'll put my camera on rather than just talking. We obviously speak about business mileage, but if I were to work between two different hospitals, am I able to claim business mileage between the hospitals?
So there was a case a good few years ago now where they brought this in. It was specifically for business mileage for doctors. So he sort of had worked in a hospital and he had a private practice. So what they had specified is that travel sort of from home to the hospital was normal commuting. Travel from the hospital to his private practice was not allowable. But I think travel between the hospitals, if they were the same sort of contract, the same hospitals, but they just had different maybe branches or something like that. So again, you can have it with surgeries where they might have different branches. The travel between those was allowable.
And if I am seconded to a different hospital for a temporary period of time, is that allowable for mileage?
So if your main contract is with one hospital, but say you are seconded for whatever reason to another one, as long as it's a temporary workplace, which I think they say is less than 24 months, then the excess travel that you have to incur in getting there is allowable. So it's still not all home to the hospital. It's the excess that you have to travel from where you would have normally travelled to the first hospital to the next one.
And I think the final question on this little bit, if I've already told HMRC about some expenses and they have adjusted my tax code, do I still need to report it on a P87 or a tax return?
If HMRC have adjusted your PAYE code, what they will do is they'll continue to use those expenses forever. So it might be a case that your normal expenses would increase year on year. So actually you might want to still do a P87 just to make sure that you are claiming the correct amounts and getting tax relief on those. But what will mean is that the refund you get, because it's already some of it's already in your PAYE code, the refund you get probably won't be as much as if it wasn't. It'll just probably be a little bit to say get the tax relief on the increase in the costs.
So you would just report the extra bit on the P87 that's not in your tax code.
But you can only claim on a P87 if your expenses are below 2,500. So if it's more than 2,500, you should report all of them on your tax return, even if they are in your PAYE code.
I'll let you carry on. I think that was all the questions on that little bit.
So some of the expenses that aren't allowable, and we get asked quite a lot, childcare costs, unfortunately, aren't allowable. We probably all wish they were, but they're not. And likewise, school fees as well. There is an element that you can look into if grandparents are paying school fees and setting up a trust and stuff. But if that is something you're interested in, then please just let us know. Again, life and health insurances aren't allowable. This is what I mentioned before. So if it's a locum insurance, it's paying out for specific locums. If it's just a lump sum, they're paying out for sort of sickness and health and whatnot, then they're not allowable. Entertainment, I'm not sure how much entertainment doctors do necessarily, but if you are taking, I don't know, contacts out for a drink, for a meal and stuff like that, that isn't allowable. And home to work travel, as I've mentioned before. So some other expenses that reduce income tax. So we obviously didn't include this, mention this previously when someone obviously said what can be claimed apart from professional subscriptions and business mileage, because this is sort of applicable to everyone. So your pension contributions will reduce your taxable income and therefore obviously reduce your tax liability for the tax year. You do have to be careful though with the annual allowance. Now, when I say pension contributions, that what I just referred to was sort of your normal ones as a doctor. But if you make private pension contributions, they also reduce your income tax. So you could make them to, I don't know, Aviva or Standard Life, whichever ones you want to contribute to. Those ones will reduce your tax as well. You just have to be careful, as I said, for the annual allowance, because, as I say, the higher your pension grows by, and it does include your NHS pension and your private pension, so it's all added together every tax year. And if you exceed the annual allowance, which is now 60,000, then you do have to pay tax on those. So just be careful if you are in the NHS pension scheme and you are making private pension contributions about the annual allowance. Loan interest on business loans. So if you are a partner, for instance, and you've bought into the surgery premises and you've taken out a loan to get that, then you can claim tax relief on the loan interest. There are some other scenarios around limited companies. If you're having to buy get loans for limited companies and whatnot, then you can claim the interest on those. Gift aid payments will reduce your tax liability as well. You do have to be careful with gift aid because it's normally, or is now, only UK charities that you can claim this on, and you do have to make sure you've done a gift aid declaration as well. So sometimes if you are just donating at a church and it's just like in the coin box, that won't be allowable because you haven't actually done a gift aid declaration. It's sort of the ones where, I don't know, I can't think of anyone now. But say it's ones, maybe the ones online where they actually ask you to do a gift aid, or you're actually signing a piece of paper saying, say you are a taxpayer and you want to donate under gift aid. Losses on other businesses. So if you are self-employed and you have made a loss on your business, that loss can be offset against your other income as well. The only time it can't be is if it's actually a residential rental loss. Those can't be offset against your other income. And then investments in EISs and VCTs are on there as well. So they're just maybe newer investments or sort of higher risk investments that are there, but so they can reduce your tax as well. Louise mentioned about the child benefit earlier on. So if you are earning, or what you or your partner are earning 60,000 or more, then your child benefit that you have received is clawed back. So if it's between 60 and 80, you'll get a proportion of it clawed back. If you're well over 80, you'll have it all clawed back. Now, some people might still want to claim the child benefit if you for national insurance credit. So if you're maybe off on maternity, if you're self-employed and you're not earning anything, and you're not going to sort of hit the national insurance threshold to pay national insurance, you might just want to make sure you're claiming child benefit to get that credit. The reason being, you have to have so many years, qualifying years of national insurance credits to get full state pension. So if you are missing years, then it's worthwhile checking that and whatnot. So you can go onto your HMRC personal tax account and you can check your national insurance record to make sure you have got all sort of all qualifying years that you've all qualifying years and that you're not missing any years. So if you know that you've worked in a year and it's missing from that record, then you can contact HMRC to try and get it sorted. If you have got a missing year because you didn't work for whatever reason, you can, and you don't think then you're going to have the necessary amount of qualifying years to get full state, you can make voluntary contributions for those missing years as well. So it's a good thing to go and check your national insurance record.
Thanks, Jamie. I think that was the last slide on expenses, but there is another question that's come in. How good is a salary sacrifice as a strategy to reduce your tax bill? Any pitfalls to be aware of, but also particularly electric vehicles which have low benefit in kind rates? There's probably two different elements to cover off here, because benefit in kind will be slightly different to a salary sacrifice, and I'll come on to a benefit in kind as we just move on to the next section. Now, salary sacrifice, so ultimately what you are doing is giving up some of your salary, monthly payment, monthly deduction comes off of your salary in return for something else, in this instance, a car. And it's quite common through the NHS. And they tend to be for a period of time. Now, they are a tax efficient way of having a brand new car every 3 years or so, because your taxable income will be reduced. So it might pull you below the £100,000 threshold. So you could retain your personal allowance, you might retain your tax-free childcare, you might retain child benefit, depending on where it brings your salary down to. And it also saves the tax because your taxable income is lower, also saves national insurance, because the threshold or the salary that they use to calculate your national insurance is after the sacrifice, and there's less pension contributions. Now, the clawback is in the year you have the salary sacrifice, your pensionable pay, if you're in the pension scheme, will be lower. So if you're in the 2015 scheme, for example, where it's a cumulative position of each of your pensionable pays every year, then it will have an impact negatively on your pension benefits because you've got lower pensionable pay, and therefore there'll be a lower pension value. Now, in the year that your salary sacrifice finishes, your pensionable pay will spike back up to whatever it should be at that point. Now, the big pitfall that can occur is on annual allowance. Now, mainly for those who've got benefits in the 1995 scheme, and the reason being is the benefits in the 95 scheme are on a final salary basis. So they look at the best of the pensionable pay in the last 3 years. So if your salary suddenly goes from 80,000 to 100,000 because your sacrifice has finished, that generates a big spike in your pensionable pay and therefore a big spike in your pension and the pension growth. So you may well exceed your 60,000 allowance, or if you're tapered, you might have less than a 60,000 allowance. Now, you can bring forward unused allowances from the past 3 years, so it may not cause a tax charge, but that is probably one of the bigger pitfalls to think about, is the impact probably on your pensionable pay and the annual allowance in the year that the sacrifice finishes. Are there any kind of other pitfalls, Jamie, that you can think of?
The only other one is you probably just might want to be careful of if you've got the salary sacrifice still in place when you retire and you are in the 95 or 2008 scheme, which is for officers and sort of the consultants, which is final salary linked, your final pension is going to be lower than if you'd have stopped that salary sacrifice before you retired, because it will, as I say, it was based on the best of the last 3 years, or in the 95, or the best of 3 years out of 10 in the 2008 one. So say if you have got a salary sacrifice, if you want to maximise your pension in those schemes, you probably want to make sure it's ended before you take retirement. Although I say the upshot of that is the annual allowance and the pension growth.
Yeah, it's never a win-win situation with these sorts of things. Can we deduct accountancy or legal fees from expenses?
Oh, you haven't done the benefit in kind one, sorry.
I'm going to come back to benefit in kind in a little while. Can we deduct accountancy or legal fees? Accountancy, yes. Now, we often treat that there's almost a notional element. So if you're doing a tax return, part of the fee that your accountant may charge you is for the kind of compliance aspect of completing the tax return, which you might have to do whether you're employed, self-employed, got a rental. There's just a general compliance legislative requirement for doing a tax return. So an element of accountancy is often disallowed. But otherwise, if we do a set of accounts, income and expenditure, property income and expenditure for your tax return, then yes, you can get tax relief on the accountancy fees. Legal fees, it will depend on what they are for, and whether they are for the purpose of your trade or not. So that is a bit of an open-ended, can't really give you an answer because it will depend on what the legal fees are for. Another bit of a niche question that's come in: if you have a house abroad which you rent out, which is then rebuilt from scratch, can we claim any tax on the building costs, etc.?
You wouldn't be able to claim it against the rental income that you have. Basically, you are, as I say, you're rebuilding from scratch. Therefore, it would be considered a capital expenditure. So you wouldn't get income tax relief on it, but what it will be is it's capital in nature, and therefore you'd be able to get relief for it against capital gains tax. So when you go to sell the rental property abroad, when we calculate the capital gains tax in the UK, basically it's what you sold it for, less what you bought it for, and any major renovation costs or anything like that. So if you're rebuilding it, that's what they would fall in. So basically any profit that you have made on that is then subject to capital gains. So you get relief for it from capital gains perspective, not income tax.
Perfect. Okay, we'll move on now to look at private practice in a little bit more detail. And a question we get asked quite a lot is whether we should do, or whether it should be done as self-employed or through a limited company. So self-employment, you are an individual. It's just you, Dr. Dean, working, doing some private practice. All profits are subject to tax on me as an individual, regardless of whether I spend them or not. They will form part of my overall taxable income. So if I've got employment, I've got a property that I rent out, I've got some shares that I get dividends on, I've got some bank interest, and now I've started to do some private work. It all goes into one big pot as part of my overall taxable income, and then put into those tiers that we spoke about earlier. I don't need to have a separate bank account. It can all just go into my personal account and be mopped up with everything. But it's good housekeeping to keep private and business separate. Really just from a record keeping perspective, easier to do the tax returns, it can save you fees. And also you have a bit of an idea, if you've got a separate bank account, the balance in your bank account, if you're not sort of taking money out personally, will give you an idea of how much profit you're making. So maybe you can start to think about how much tax you might have to pay. There are no formal regulations in starting or stopping. If I'm just doing private practice for the first time, I've never had to do a tax return previously, then I would just need to register with HMRC to tell them that I'm now starting in business, because they would need to update my record to issue or open up a tax return record for me, and know that I will need to start paying national insurance. Nothing goes out into the public domain. I don't need to prepare formal accounts. I can just, add everything up on a calculator and pop it into the system. So it's much simpler and it's cheaper. As we've discussed, there's a greater pool of expenses that can be claimed with compared with employment. Generally, anything that I need to run my business, I can claim in the simplest sense. If we then think about a limited company, now this is a separate legal entity, so it's much stricter. There are regulations around having a limited company. There are processes you have to follow, forms that have to be signed and submitted to different people. So much more structured. And there is information out there potentially in the public domain that anyone could go in and have a look at. Although it may be your company, just you involved, it's your money. It's not your personal money, it is the company's money. And generally, if there's movement from the company to you, there is a tax consequence. And that's why it's really important. You have to have separation. So the company needs to have its own bank account, which some banks are really straightforward, others are a bit of a pain. You have to register the company with Companies House, so separate to HMRC. You need to set who the shareholders are, how many shares they've got, who the directors are going to be. So you probably need to start thinking about having an accountant. Now, you don't need an accountant. You could do it yourself, but you'd need to understand accounting legislation. Whereas with self-employment, you could do your own tax return. It's useful to have an accountant because they can help with identifying any missed expenses, make sure you're maximising the claims that you can. But with a limited company, you're probably going to need one. So as a self-employment, I paid income tax. With a limited company, the company pays corporation tax. So it's a completely different tax regime. The main rate is 25%, so flat rate on profits. Unless your profits are less than £50,000, at which point you pay a flat rate of 19%. And these rates change in the last couple of years. So it is more expensive now to have a company in terms of corporation tax. If your profits are between 50 and 250,000, then your rate is 25%, but you get marginal relief. So it's almost like a sliding scale. So the closer you are to the 50,000, the lower the rate of tax, the more marginal relief you get. If you want to take some of this money out because you as an individual have earned it, you can do so generally by way of a salary. Now you may need to do a payroll, and then that salary would be taxed on you under the normal income tax rules. But if you've already got an employment, which is what we often see with hospital doctors, this tends to be in addition to your NHS work, there's no probable benefit to taking a salary, and so therefore the other route is a dividend. And we spoke about the dividend income tax rates before, which are 8.25%, 33%, 39%. So the income as an individual, if I don't take any money out of the company will pay its corporation tax. I won't pay anything. And that's where being a limited company can really help, because it will give you control. You can ring fence the income. So if you're worried about hitting that £100,000 threshold, you can limit the dividends you take or the salary you take from the company to keep you below £1,000 threshold. So it gives you control, as opposed to self-employment where you're just taxed on it regardless. So what are the pros of using a company? Possible tax savings. Now, a question that I always get asked, or a statement that I often hear, oh, I've been speaking to a colleague, they've got a limited company, they say I can save tax. Is that right? My answer is it depends. And it depends on the structure and how you take the income out. Where it can benefit most is if you've got lower earning spouses, because you can share the income. They can be shareholders, other family members, grandparents who maybe are earning, only have pensions, can take out dividends, maybe put them towards school fees. So it gives you that flexibility but you have to make sure it's structured right from the outset. Otherwise, it's quite tricky to start moving shares and bringing other people in and then taking money out. So it has to be right from the beginning. It gives you limited liability. So if you have a claim against you, obviously you have insurance which covers off that. But if, for example, to put it in context, you had an employee and they came and went to the employment tribunal for unfair dismissal or something like that, you are limited to the money you put into the company. Whereas for self-employment, if you employ someone, your personal assets are at risk. So it has that limited liability. You can make pension contributions. Now, we have covered this off previously. You would still need to be aware of annual allowance. But if you have, again, a spouse who's not in the NHS scheme, the company can make contributions to them. There are other flexibilities, benefit in kind. So as we had a question asked on this, if the company could buy an electric car in the company name, so the company will get tax relief on the cost of the car against its corporation tax, and it will pay for the running costs, so the fuel, the insurance, repairs, etc. You as a director are what we call a class as an employee. So you as an employee are being allowed to use that car free of charge. So there's a benefit to you as an employee. Now, electric vehicles do have low benefit in kind rates. So at the moment, they're 2% of the list price. So if you've got a £50,000 electric car, at 2%, the benefit in kind value to you as an individual would be £1,000 per year, which you would pay tax on. So if you are a higher rate taxpayer, it will cost you £400 out of your pocket to have a brand new electric car at your disposal for a year. And obviously it's ongoing year on year. So you don't have to pay the running costs, you've just got to pay the tax on the benefit in kind. Now, those rates are fixed to the end of March 2025, at which point they obviously could change. If you start looking at higher, racier cars with big CO2 emissions, it starts to creep up and up and up to about 30-odd%. So it starts to get less efficient. But it comes back to this flexibility of how, if you don't need the money to take the money out of the company, what can we do with it? The cons, it is more complex than a sole trader. As I said, you've got to follow accounting legislation. There are more administrative requirements. The accounts have to be filed. The tax return has to be filed. There are other statements, confirmation statements that have to be filed throughout the year. So they will probably be more costly because you would need an accountant. As I said, you have to make sure that the setup is right to begin with. As the corporation tax rates change and the dividend allowances change, as we've seen, they were 2,000, they then went to 1,000, they're now 500. There could be tax disadvantages. I'd normally say 3 elements to think about. How long are you going to do the private work for? Because if it's short term in nature, probably not worth setting a company up to have to go through the rigmarole of closing it down. How much are we talking in terms of income? Again, if it's 10, 20,000, might not be worthwhile. It might, but it might not. And third, and probably the most important, is how much money do you need to take out of the company? If it's just you as an individual, as a shareholder, and you're taking all of the money out of the company, you're probably worse off than if you were doing it just as a self-employed individual. So 3 key things to think about when using a limited company. Now, I'm conscious we're 5 minutes over and there are a couple of questions. That was my last slide. So I will just touch on the couple of other questions that have been raised. If you are under PAYE and earn over 100,000, do you need to register for self-assessment, or are HMRC aware and will they automatically do it and send you a notification? Do you want to take that one, Jamie?
Yeah, so the rules for 23, 24 have actually changed, and going forward, the threshold where you have to do a self-assessment tax return, and you are only in PAYE, so you only have employment income, has actually gone up to 150,000. So unless you have other untaxed income or you've got child benefit or something like that, you won't need to do a tax return if your employment income is under 150,000. Now, the issue with that is it could mean that if it's not being included on your tax return, it could mean you have to pay more tax when HMRC reconcile everything after the end of the tax year. So just be aware of that. But if you are over the 150,000, normally HMRC do send a letter out after the end of the tax year saying you do need to do a tax return. There have been people who have been missed, so I would just be aware of it, that if you are over the now 150,000, to register yourself and don't rely on HMRC.
And the last question, unless anyone gets in there nice and quick, if you do private practice as self-employed and also do NHS work as a primary job, is the self-employment tax at a higher rate for a second job? So effectively, yes. So if you are employed within the NHS, depending obviously how much you earn, you will be used up your personal allowance, probably used up your basic rate band at 20%, and you're probably now into the higher rate tax bracket at 40%. So if you then start to undertake private work as self-employed, ultimately what that's doing is that any profit that you make basically comes on the top and is added on top of your employment income. And so it's going to be taxed at 40%, potentially into the 45%. Now, you won't have any tax deducted at source because it's a self-employment. So you will need to make sure as you're earning the money that you are putting away 40 to 45 plus national insurance. So actually, you probably want to be thinking about putting closer to 50% of those earnings away for tax, because they will come due for tax once your tax return has been filed. But ultimately, yes, in the simpler sense, it kind of just adds on top of all of your taxable income. So generally will start to be taxed at 40%. If you move away from the employment and you go kind of fully private practice, again, you'll start back 12,500, 0%, 20%, 40%, and you'll start up with those tiered brackets. And then one last question, which I'm just going to throw in because we do get asked this often about limited companies as well, is about children and children being shareholders and paying dividends out to children. You can have a child as a shareholder, but any dividends that are paid out to children under the age of 18 will be taxed on the parent. So you will be undoing probably any tax advantages that you're looking to save by making use of their personal allowance, basic rate bands if they don't have any other income. Once they hit 18, it's taxed on them individually. So if they don't have any other income, then there could be tax savings, because you're effectively, they would pay some at 0%, and then maybe some at 8.75%, as opposed to you who may be paying at 33% or 39% for a different or higher rate of tax. Okay, I think that is all the questions answered. Thank you everyone for joining us this evening. Hopefully it was useful. As I said, once you come out or we close the webinar down, there will be an automatic screen pop up for feedback. Obviously comes through anonymously, so please do be as honest as you can. And as I said, in particular, if you have any particular topics you would like covered, let us know. We try our best to cover all of those. If you joined us late, you will automatically be sent a recording from today's session in a couple of days. And also, because I think we had a mixture of GPs and hospital doctors on here, just to let you know, if you are a GP, we did put on a session last week, which was similar but aimed more at GPs. So there will be a link when the recording for today comes back out. There will be a link to the last webinar we've done. So please do go and have a look at that as well. But otherwise, I would say thank you very much. Have a lovely evening. Good night.